Welcome to Tax Tip Tuesday. One of the most common pieces of tax advice business owners hear is, you should become an S corporation to save on taxes. While an S corporation can create tax savings, it is important to understand how it actually works and whether it is the right fit for your business. If you operate as a sole proprietor or single-member LLC, your business profits are generally subject to both income tax and self-employment tax. Self-employment tax is currently 15.3% and covers Social Security and Medicare taxes. As your profits grow, this can become a significant tax expense. An S corporation changes how business income is taxed. As the owner, you are required to pay yourself a reasonable salary for the work you perform in the business. That salary is subject to payroll taxes, including Social Security and Medicare taxes. However, business profits remaining after paying a reasonable salary may be distributed to you as a shareholder distribution. Many business owners believe distributions are completely tax-free. That is not correct. S corporation distributions are generally still subject to federal and state income tax through the shareholder's individual tax return. The potential tax savings occur because qualifying distributions are typically not subject to self-employment tax or Social Security and Medicare taxes. This distinction is where many of the tax benefits can arise. However, the IRS requires owners who actively work in the business to receive reasonable compensation. You cannot simply pay yourself a minimal salary and take the remainder as distributions to avoid payroll taxes. The salary must reflect the duties performed, industry standards, experience level, time devoted to the business, and the overall profitability of the company. An S corporation is not automatically the best choice for every business owner. The election generally becomes more beneficial when the business consistently generates profits above the owner's reasonable compensation, when the tax savings exceed the additional costs associated with payroll processing, tax filings, accounting, and compliance requirements, and when the owner is prepared to operate the business as a separate legal and tax entity with proper record-keeping and payroll procedures. For example, if a business earns $80,000 annually and the owner's reasonable salary would be $70,000, the potential tax savings may be limited after considering payroll and compliance costs. On the other hand, a business generating $150,000, $200,000, or more in annual profit may see more meaningful tax benefits depending on the owner's compensation requirements. The right answer depends on your specific facts and circumstances. There is no one-size-fits-all solution. At Woodson Accounting and Financial Services, we help business owners evaluate whether an S corporation election aligns with their tax and financial goals. We review profitability, compensation requirements, payroll costs, compliance obligations, and long-term planning opportunities to determine whether the election creates real tax savings or simply adds administrative complexity. Before electing S corporation status, make sure you understand both the benefits and the responsibilities that come with it. Book a consultation with our team to determine whether an S corporation election is the right strategy for your business. And that is your Tax Tip Tuesday.